Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 5th, 2023. It is 11:09 Eastern Time, so I'm starting the video, and we're going to go over, as usual, start out with the equity market. So we'll look at the Magnificent Seven, the big stocks that move the market, and maybe a couple more beyond those to highlight key levels. What I'm going to do here is try to, again, reiterate the big picture. As I tried to do this morning, I got out charts too, and lately, and I usually most often post intraday charts, 60-minute charts. I've even gotten down to some of the shorter term time frames lately, kind of doing more active trading. But again, I want to reiterate the bigger picture is what helps formulate, my thoughts on when we're, let's say, falling to a support level. Do you want to look to short a break of that level? Expecting that, or are you bullish and you want to buy a dip on a pullback if you think the trend is bullish? And so and again, you can make a case either way when you pull back to support, especially when you have positive divergences if you've had recently. So for me, you need to really have a pretty good amount of evidence to not go pretty aggressively long when I see bullish, i.e. positive divergences on the indexes, both SPY and QQQ on the 60-minute time frames. Those are my probably my go-to, my favorite swing trading time frame. But again, very important, I never take my eye off the longer term charts. And so that's the point I tried to convey today, is what happens here on the daily chart and even especially the weekly charts. I don't want to use the word supersedes, but certainly needs to be factored in, because we had some multiple sell signals. Everything I was kind of looking for, positioning one after another. Each of those breakdowns increasing the odds that these deeper targets are going to be hit, and further diminishing the odds that we'll get that marginal new high scenario, which I still can't write off. Nothing's changed in the last few days. If you're kind of, where is he? Is it bullish, long, short? We've been bouncing off. Remember, I've had color coded this level as a big level, and we're still, that I did that ahead of time before we even got there. That's because that was to me a very important support. So this is the best way to summarize it. This is a battleground. This is a key battleground between the bulls and the bears, and that's how technical analysis works. Whoever, I don't want to oversimplify things, but whoever wins, in other words, the bulls, if they can clearly start to break it away from here, now you have this little trading range, and run it up and start taking out the additional levels. Even, again, the odds are going to change. I always use that betting thing, the betting, especially the ponies, the bets change in real time, and they change pretty significantly up until the betting closes based on how the bets are coming in. So that's the way I look at it. I might be bearish and expecting this one day, but then all of a sudden, boom, 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 we just pop some levels, and some of the things that should have happened, for the bears to take it down, don't. And that's it. It's really, you never know. It's, you just pull back the screen or the curtain, and what you're looking at is a market is full of buyers and sellers. And at any point in time, if there's more buyers, and it doesn't matter if it's natural buyers, retail traders, institutions, even for those of you who believe in, the PPT and, the government buying and shoring up the futures, again, it doesn't matter. All that matters is being on the right side of the trade. So that's it. So be flexible. And again, what I've been trying to convey, this is an important level, I believe, an important technical juncture. I think ultimately resolves this way to the downside. But, getting married to a view like that and staying short, if the market does this and goes up to marginal new highs, will just crush you. So you have to adjust. And also, and again, you can adapt pretty quickly here. So another way to kind of put it, you drill down. Let's just say, for example, we did breakdown. Okay, and is that bearish? Is that going to be a sell signal? And we go down to T2. Does that increase the odds we're going to go down to my additional target? It does. But then afterwards, or if we did it the same day and reverse suddenly back up and above there, well, guess what? That has the potential that would be a false breakdown, a bear trap. So that's where you have to adjust and adapt pretty quickly. Okay, so here's where we're at. Let's not overthink it. We're still at that key support level. That's the daily. All right, so that's how it looks on the daily time frame. And remember, it's been a a sequence of bearish events that have been building and increasing the odds that this may have been the end of a bear market rally, and this is the start of the next leg down, but it's still way too early. I mean, when you step back, turn off all the lines and levels, we're still a whole lot closer to making new multi-year highs than we are multi-year lows. We're still well above the 200-day simple and exponential moving averages. So it's going to take, again, it's incremental, like I said, incremental. The case that I'm referring to, are we in a bear market, or are we going to take out these 2021 lows? Again, incremental, if and as each support level's taken out. But let's not worry about that too much. I mean, I think most of you here, there are some people ask about 401k longer term stuff, but I think most of you are active traders, and and so that's what we're focused on lately, is whether to be long or short. All right, and then of course I'm going to get to the other things in a second. There's individual stocks and sectors that still look good, and we don't have to as much worry about this because some of those individual trade ideas I've thrown out are completely unrelated or uncorrelated, if you will, to the stock market. So natural gas has nothing to do with QQQ, and even some of the individual stocks and sectors I've been looking at. For example, the banks have nothing to do with QQQ. Their banks are, the financial sector is not represented in the NASDAQ 100, only in the S&P and other the smaller indexes. Okay, those are the levels. So let's move on here. 60-minute chart. I have a couple variations. I've been posting the futures lately. Remember, we had these bounce targets the other day on the 60-minute chart of QQQ, and I haven't pulled them off yet. But at that point, when I reversed back short, kind of eliminated that. At least from here going up there and breaking through, and so here we are. So we're at pretty good support. What I'm going to do right now, I'm going to take this line right here at 355.78. I'm going to put it here where it should be. That's a major reaction low right there from mid-August, and that's about where we're at now. So we had a slight undercut, and that undercut was a divergent low with bullish, aka positive or bullish divergence on the 60-minute chart. And so that's right now, that's a false breakdown, whipsaw, and we're holding above this level. Again, the price action's pretty weak, and again, I can make a case to go either way, but it's not that hard. We break down, we undercut the lows, especially if we can take out the divergences. That's going to significantly increase the odds we're going to go a lot lower, in my opinion. But it's not over yet. The bulls can still try to pull a rabbit out of their hat here. We're going to look at some of the other things they need to do that with. I'm going to loop over to the website real quick, and I like to always highlight some of the questions or replies I've made to questions on the homepage. And I do that usually because, question from one is often a question by others that others might have or benefit of. All right, so there's whatever. There was the same person that was before, we're taking 40 minutes plus to get a post, and all right, so I just clarified the posts are all time stamped right here at the bottom left corner when you go to the home page, the time. And then, this is a good comment here. Post says 9:57. They got it within a minute. What's interesting is the screenshots are 20 to 22 minutes old. Yep, I also screenshot. I've always tried my best for full accountability. I make sure everything, my videos, I put a timestamp on so you can see as it's being recorded what time it is. Every chart I've ever taken on the site, it's always time stamped, and so that way, because time is everything when you're trading. It's especially active trading. If you're a long-term investor, it doesn't matter if the chart's 30 minutes old. If you're active trading, yeah, absolutely. So all right, so my reply to that is, and this wasn't, I don't think it was wasn't a criticism, it's just factual. Yeah, they're 20 minutes old, and the 20 minutes that it took, the market moved, we got rejected off that level. And so here's my reply. Yes, there's always going to be at least a 5-minute and quite often longer delay from the moment I screenshot a chart or charts, especially obviously the more charts I'm screenshotting and putting in a post, the more commentary. It's usually different indexes or different securities, so then it's going to take me longer to compose that post. So bottom line is I have to screenshot them, then annotate those, and then compose a post. I'm not using Chat GPT, never have, wouldn't do it on this, because everything is, needs to, it's what I'm seeing and not what some computer, model is going to write. So based on that, yes, it does take about a good Again, if it's a single chart, something quick, I'll screenshot it, fire it out. You might get that post within 5 minutes of the chart being taken. Otherwise, it's going to be maybe 20 minutes, sometimes more. Again, it depends on the content. However, the point I tried to make here is the 60-minute charts that I gave you this morning, meaning right here, are exactly the ones I gave you yesterday. I did at least two iterations of these. And so all the levels, all of them except NQ, I added on NQ this downtrend line right here. I think that's the only thing different. And so my point being, if yesterday you replicated the levels, we were here, we took that out. I said, if we take that out, we're probably going to punch up to the next one. We did, and we hit it. And we hit it. We didn't just hit it. When you look at that, this here, we hit it yesterday. And I mean, this is what I do, and I think I do best, is identify levels, looking at a chart. And I can kind of see the levels that I think, and more often than not, that are going to come into play as support or resistance. Therefore, you can trade off them. And what that means is two things. You can either, take profits, game a pullback. I posted that yesterday, I believe, that we hit that level and you could game, and I did quick pullback, shallow pullback, and then I drill down to the 5-minute charts, and that's where I decide where to cover. And also you can see, so it was a battleground between bulls and bears since yesterday. And then all I did is add the trend line. But again, and the other levels were already there yesterday as well. And the way this works, and it still does, if they can power back up, I'll get to the updated charts. But if they can break out, then that's bullish. And now you have intersecting resistance levels, just like on ES. And then if you can take out the next one, then you go up to the next and final. That was still maximum at this point in time, my maximum upside bounce target there. But if we get rejected, as I said in the post this morning, then we're probably going lower, especially if we undercut this, and especially if we take out the divergence. That means you have divergence here, 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 here. And then once that line slopes down, and this one does, you no longer have positive divergence. And that just doesn't mean you can't rally. It just significantly diminishes the chance that you're going to have a meaningful rally, in my opinion. So hopefully that all makes sense. There it is. I believe the same exact chart posted yesterday morning on ES, and same levels. So, we traded up and we hit that perfectly to the button. You can see, I think you can see it. I'm not zoomed in here, but we hit, boom, that 4305 resistance, and then came back, and this is where we were this morning. And that's it. So that was then. This is now. Got rejected. And again, the takeaway this morning, as I said, and I often do, resistance is resistance until unless taken out. And it didn't get taken out. And so what happened is, finally, after the buyers couldn't pop that level and break out, you got a rejection. And then I went on to, and this is just kind of an extra, sometimes I'll do it down here because I can't sit here. It's not what the site is about, day trading, active trading. It is impossible to follow a day trader. I've always used the analogy. It's like, you want to learn football, try to follow the quarterback on the field during the game, and he says, mirror my every move. If you follow football, he's looking, and he's got 3 different receivers he can hit, depending on which one's open. If that doesn't happen, he'll have to either keep the ball and run or shuttle to a back if he has a back in the backfield that's open. There's a lot of, but it's all instantaneous kind of stuff. There's no, you can't follow an active trader. Even swing trading, and again, that's the point of it. Get these levels out ahead of time, and there they are. So you can replicate them on the chart if you agree with them, and then act accordingly. So I followed up on that post, just hey, because that was real time. Right after I took these screenshots, I said, here we are, and this was not that long ago. You can see it's getting timestamp 11:43 right now. It's 10:43. It's now 11:23. And so I said, look, here's a little downtrend line if you're interested. On this is just 5-minute micro analysis. We had a minor uptrend line we just hit, and I favor a little bounce up to at least this downtrend line on the 5-minute chart. This is what I've been trading off active trading recently, and usually. And that was the SPY. You can see there. So I'll get to the updated chart in a second. This was over 40 minutes old. And then you see this little purple line here is a gap right there in QQQ, and if that doesn't hold, then this is the next support level, and if that doesn't hold, then it's not really that good. Each one of these have taken out, increases the odds we're going to go lower. But remember, we're coming off this 5-minute divergent low, and you really, on the 5-minute chart, you have this triangle pattern right now on QQQ. So bigger picture, downside break is going to be bearish, upside break would be bullish. Upside break would also take us above. Remember, we got rejected on the downtrend lines and price resistance on the 60-minute charts of ES and NQ that I just started out in the video and got out to you this morning and yesterday. That's where we were. That was today's high. So pretty much if we pop today's high, we're also going to pop this 5-minute triangle, and that should be near-term bullish. Okay? It's a lot. It is. But, this is not an easy game. If you want to succeed at trading, it's not a part-time endeavor. Look at a couple things, listen to one or two blogs or podcasts or whatever. You gotta be on top of this, especially if active trading. And again, if that's not your thing, if now you're saying, you know what, I don't have time for this, it's just too much. I do also continually update bigger picture where swing and trend traders, you don't have to worry about all these little minor things. Could we pop here? Yeah, it might be good for 3%, maybe 4% run to the upside. But in bigger picture, I still don't have us yet, at least going to new highs. So, if you're longer term swing trend trading, I still think the risk reward is favors to the downside. But then that all loops back to where I started the video today. You can't make I wouldn't add to, or if you didn't have a position right now at all, I wouldn't add to an existing position or start a new or at least full position until these levels go that I highlighted on the daily chart. Because remember, we're sitting right on support. In Trading 101, again, now I'm speaking to the trend trader or the swing trader, not the active trader. I was just talking to the active trader on the 5-minute chart. This is a daily chart. And this says, support until unless broken. We had plenty of shorting ups there, so some of you might already be in swing trend shorts. And this is where, you take those levels out. That's where the next, objective level. SPY already broke down. I have different boards on SPY and QQQ. There's the head and shoulders pattern I highlighted recently. So SPY's, broken just about every support from back here, starting with the bearish engulfing candle, which is a topping stick that has usually it inflects the trend, from a bullish to bearish trend, just like the bullish engulfing candle there. So a lot of evidence was, I made the case, and I'm just looping back to it, that longer term, this is a case that we're going lower in the S&P and in the Nasdaq and in the stock market as a whole. And so nothing's changed to my longer term, intermediate or to longer term bearish view. But near term, yeah, there might be some, rally, like I said yesterday, maybe 3-4%, and that's still not off the table yet. Even though we got rejected at resistance today, we could still power back up, again, based on what happens down here on this little 5-minute chart. So, I didn't get back to it. Okay, there it is. So there's the uptrend line. I'm gonna tweak it a little because I'll zoom in here. This is what I do. I always, I kind of rough through it. What I'm doing now, if you notice, I had undercut that candle. Now I'm right at the bottom of it. I'm being precise because that's what these, I think, computers, both, the better fit of the trend line. 1, 2, there's 2 candles there actually, and now 3, and that's the one I said, you can reverse go long as an active trader. My minimum target's the downtrend line, but at this point I think would probably carry through there and hit that 429.50 level again, possibly. So there it is. So that's the active trader that shorted or the rally into resistance this morning or was already short. Again, that's active trader stuff. QQQ, there's the gap. That's that same chart I posted 45 minutes ago. There's the gap right there, bottom of the gap. Traders will see the bottom and often step in a little bit early. Who wants to try to eke out the last 1/10 of 1%? So that's why the same reason when I'm short. And if that's my price target, I'm going to cover a little bit above. And if I'm long, looking to go long up to whatever right here, that reaction high, I'm going to sell my longs there so I don't miss the turn in case the sellers step in early. Okay, yeah, and you can see all of these are resistance levels if we can rally here. Okay, moving on. While we're on this, let's just look at a few things related to the stock market. The VIX continues to power up. Remember, the VIX put in a divergent low. There's my other board. That's one. We've been building for a while. Divergence, building, and then boom, it's been, and now we're back testing. This is big, by the way, guys. I highlighted in, over the last couple weeks to months, several times I'd jump out to the weekly chart of the VIX. That's what I just did here. And we had this big triangle. Most important, this one's even better defined than that downtrend line. This uptrend line off the 2017 lows, lots of reactions, very clean. See, very, very clean trend line. And we broke it there. And then we came down, put in divergent low, and now we're back testing. So you have the VIX at resistance, back testing that level. It's either going to get rejected, which would mean a stock market rally, or it's going to pop on through there and then head up. And the VIX, when it wants to move, just don't underestimate it. And that's when the market drops. You get these big spikes up. Here's a couple really big ones coincided with corrections and things like that. That one's COVID right there. And you can see the VIX never really went that wild in 2022. That's why I don't call it 2022 a bear market. I call it the initial leg down in a bear market, but really just a correction that brought the indexes back to some long-term trend lines and support levels. So yeah, we've yet to see a real meltdown type move in the market like we have in the past here. Okay, Magnificent Seven in order of market cap, descending order. So largest first, Apple. I used to remember back here, I did a post about the $3 trillion kiss of death, hit the $3 trillion club. Everybody was tripping over themselves to buy Apple, and that pretty much marked the high. It was back here maybe. Anyways, it's 2.7 trillion now, so it didn't hold it. By the way, that wasn't just, I went back every time it hit 2 trillion, it hits these milestones. And that's usually the kiss of death for it, at least for the time being. Not that, Apple's, gone. Just saying, it usually peaks out from its bull runs right around that time. And so key levels, what I've done here, guys, just real quickly, is I've color coded purple now, the key levels. Remember, Apple had this beautiful overstretch, big bearish rising wedge, big negative divergences, broke down, back tested, broke down right before earnings, back tested, and then gave up the ghost right there on the earnings, and then boom, it's been in a clear downtrend since. Downtrend simply defined as lower lows and lower highs. However, is it a correction with a move to new highs coming? Maybe. It's the best looking chart that I've seen right now, or I'm seeing of the big fangs, that has big, clear positive divergence with indicators, both the RSI and the PPO clearly making higher highs, and also it's at this support. So I have it colored up purple, that 170.37, because that's where I've had the line before, and I'm just going to leave it there. It was this support right here, and we were dancing on. We had a little whipsaw down through there in a recovery, but remember, it's been holding the 200-day. If you turn off all the lines, the other big levels for Apple are the 200 exponential and simple. So it has a confluence of support below it. But remember, support is support until it's broken. And so based on my longer-term outlook, I put good odds it's going to break. And I've said this before, and I mean this is from my experience. Nothing is more bearish than a beautiful, again, this is a beautiful bullish setup. In nothing in trading that I've seen is more bearish than a textbook looking bullish setup that fails to materialize or breaks out, a false breakout. So if we just smash on through here and the buyers don't step in and buy these divergences, and they don't buy the pullback to the 200s after such a big drop to get to them, then yeah, it's going to be ugly in my opinion. So either way, that's Apple. So I had the purple line at 170.37, but really now, since you have that distinct reaction low before there and the 200 simple, that line should be here. Let me just put it there. Let's put it down here around, it's right on the 200 and just below that level. So we'll make that purple about 166.60, give or take. Solid move down below there, especially a daily close. That's get out of Dodge time for Apple and the market. So I'm going to set an alert so I remember that one. I'll go through the rest a little quicker here. Microsoft, I've had the line here again. I colored them up purple so you can see 311.56, even though technically we pierced it intraday. Just if you look closely here, I'll do it for you. couple times there. So really you need to take out the lows just below it. But again, I'm leaving it there because that's still the big support level. Again, on a daily chart, doesn't matter what you do intraday, it's how you close the day. A solid red candle below there would be a breakdown, especially on a daily close. Of course, you have the 200 exponential and simple just below that. And the way it works, they're just bearish check marks. You know, you get the first breakdown there, you take out the 200 simple, you take out the 200 or exponential first, then the simple. On a daily closing basis, don't put too much into an intraday break unless we're in a waterfall type sell-off and you're down here. You get down there intraday, you're not going to close back above them. It's very unusual. So then you can, be safe to short, add to your shorts before the day is over, in my opinion. All right, then next support / target right there. And so there it is. Again, you want to take a simple look. Say what you want about where you think things are going. You have your opinion, I have mine, but you can't argue where this is an intermediate or near-term downtrend. The longer-term downtrend is kind of mixed right now. We're flat where we were, when the market peaked. So this is your, if you want to call this the intermediate term downtrend, in this the near term, you want to label them that way, that's fine. But until we take out this high, then you're in this, again, a near-term downtrend. That's your current trend right there. And again, coming on the heels of a lot of technical evidence that says it was a significant top, not just a correction. In other words, all this that I've covered in recent weeks, including this breakdown and all that, support the case for a more lasting top. Alphabet, you could color it up purple if you want, but the big purple line I have is at 127.15. I've had it there for a long time. As a key level, you can see it was resistance, breakout, back test, successful back test, another back test recently. But the bigger picture to me, what I see when I look at this chart is, which is highlighted in advance too, big bearish rising wedge pattern, breakdown there, follow through to the downside, a little kickback rally, and now you have, so this is just the initial breakdown here. And based on this size of this wedge, I think there's more to come. And but however, you need to now, the next sell signal is going to come on a break of this minor uptrend line right here, and then that should take us down to 127.15, big support. And when that goes, I believe I already have an alert set, but can't hurt. I can have multiple alerts. 127.15 is the big one right there. And so that's how it works, as if and as each of these levels start to go, and I'll get alerts, and they'll probably come on the same day or within the same period of time. And maybe they come next week, maybe they come 3 months from now after a marginal new high. We'll see. Amazon, I put the purple line at 122.97. Let's round it up. Everybody likes round numbers. So 123 is a magic number, which is basically the recent reaction low and the 200-day just below that. NVIDIA, 403.30, 375, and then the uptrend line. Those are the purple key levels. This is probably almost, if not as important or even more important than Apple, just because it is the poster child of AI and all things, why it's different this time, while the stock market and tech can support such high valuations in spite of the biggest rate hikes and interest rate inflationary environment in decades, which normally would just hammer tech stocks. So, there's a big disconnect between the fundamentals right now and where we're in the technicals, how high tech stocks are compared to, in spite of the increase in rates that we've had, which has really been unrelenting so far. So that's it. Tesla, big level to watch. It's not a support level. It's a resistance. There's your bear market downtrend line, still below it. I don't have a purple line here, but let's just use that 212.80 level. Meta, put a purple line right there below the recent lows. Those two reaction lows. That's about 275.85. Broadcom, purple line at 787.22. I think that's the support that'll do the trick right there. That's just a gap. But it's a huge thin zone, so I think it would look something like this. Pretty swift move down to that 644-ish level, and if so, and that's where I think this one's going based on the charts, whether we put in a marginal new high or not. And I still don't favor that right now, but that's a 21% drop from where we're at. And again, these are the top components of the NASDAQ 100. There's Costco, divergent high, big, clean, negative divergence. I put good money at Costco's coming to this primary uptrend line and ultimately going to break it. That's a big trend line. It goes all the way back to, pre-2018, 2017. Look at that. So we break that. And then if we break this trend line, that's a secular or primary bull market uptrend line. That's going to send Costco much lower. And based on the divergences, I think it's coming. At minimum, a pullback to test it again. Adobe, purple line at about 502, 502-ish. You have a little spike low. You gotta pay attention to these spike lows. They need to be taken out. And I think it'll happen. I have a high degree of confidence. Big divergent high. So here's price targets. I've shared this one in the past. T1's at 470, T2 zone right here. T3, which is the intersecting uptrend line, and about 390 support levels. So that gives you, if I had to either go long or short Adobe and throw the key away and, come back and unlock the box in 6 months, if I could set, buy to cover limit orders, all day long I'd short it. I'd be fine if it goes up, makes a marginal to a high. I have a high degree of confidence it's going down there. So it's going down 24% from where it is. It's a matter, is it going to go up another 13 or so percent first and then do it, or is it going to go down right away? If it goes up any new high anytime soon, draw it out like that, it's just going to look like that, be a marginal new but still divergent high, and that would mesh with a new high scenario in the market. Or maybe it looks like we pop some of those near-term levels. I'm going to draw out a little head and shoulders pattern here. So maybe it looks like it's running up, but then all of a sudden the rally gets sold into. You've got a beautiful little head and shoulders stopping pattern there with a neckline at S1 for support level, and then a measured target would take you right down to about that second target zone on that head and shoulders pattern. Head, left shoulder, right shoulder, and neckline down here. Okay, I won't go through them all, but there's Pepsi. Again, this is bear market type stuff. This is, you wait, shorts give up. They see, the bearish developments. This was highlighted all the way back here as a short setup, short trade idea. We broke down the trend line there, impulsive drop. This is what a downtrend looks like. And I think this is just a stock market, just a little bit ahead of where it's going. Then the bigger sell signal, again, just like I was covering on, what was that a minute ago? Costco, that long-term, there was a long-term uptrend line on a blue chip. This is one of the bluest of blue chips, Pepsi, and broke down, back tested for a couple weeks, couple times. And then when the bulls saw that they couldn't regain that level, they finally recognized what it clearly was as a breakdown and a back test. Boom. Went down, and again, these are targets I've had here. I laid these out for you weeks, months back here. Created back in September of 2022. And in previous videos, I covered this. And all these levels, these weren't added retroactively. So, an active trader could have gamed this one down from there. That would have been your next sell signal add-on. If you missed the breakdown, you could have shorted there on the back test. Hit that level, covered, and then, you had a reaction here, but there's a good example why I define a reaction of one of two things. When you're falling down to a support level, a reaction is either a pause, consolidation, or a bounce. And this was a consolidation. You hit it, and the bounce was very muted. And I've always used the analogy, you drop a golf ball or a hacky sack onto a concrete floor. The golf ball is going to bounce. That's the reaction that way. And the hacky sack's going to just stop and stick to the floor. And that's what that was. And that's the weaker of the two. When you see that, there's just no buyers on the other side of the trade. And that's why you just had that boom, giant wipeout candle today with Pepsi going down. And again, didn't make these up. This you can see right here on the pop-up box. I created that level back in 2021. And boom. And we stopped there cold today. And we are having a reaction. We'll probably bounce from there. You hit it to the button. And that's where the buyer stepped in. So again, these are all trade ideas, but they're also the bigger picture. I'm looking at one component after another, one sector after another, breaking down red flags, And but because we're at support, Pepsi, the buyers are going to step in, put good odds. They're going to buy here, or little less odds they could go down after a little reaction to the next target. But I favor probably step in. It's really oversold. You get this oversold. Do not short a stock, a blue chip stock, especially Pepsi, that oversold. You could buy it here right now, guys. It's a long trade idea. Cover the short. If I was in it, I wish I was. I'm not. Full. I'd have a full hard reverse here, and I'd even allow it to go down here with a stop below there and bounce back at least to that level, depending on what the market does. Now, if the market breaks down, has a waterfall sell-off, let's just, then I turn my focus to the weekly charts, and that's where I think a lot of traders, I think are short-sighted. I do things different than most. I listen to others out there and watch TV. I go to the weekly charts, and this tells me this is a big, giant divergent high right here. Primary trend line's broken. And this is, and again, let's see, T1, I created this back in 2022, and this is where we're going minimum based on what I see here on the weekly. So while I might gain a quick bounce as long as the markets don't break down and take out those support levels I covered in the earlier video, I think there's a good counter trend rally trade in here up to about what I just showed you there. And you can see its resistance right here. I'll add this line now. So a little bounce, but then ultimately we're going back down another, I think, 8.5% before the buyers step in. This is where, if you want to mark your calendar, or not your calendar, set a price alert. If we get there, and if I can make a case to go long the market and cover shorts at that time, this is a stock to buy. You want to own Pepsi, that would be a good support level. So bear market target, it's been there for a while. Okay, let me just end here with this one. Nope, all right, that's enough. ASML, one of the largest semis, but that one's at support right here. All right, let me cover the other things I wanted to cover. So that's the Mag 7. And there's individual stocks. Like I mentioned, Carvana is one that I've stayed short at. And just broke today. The market, now again, I reversed and showed you the case to play a little bounce in the market. So that may bring us back above here. But if it holds this breakdown today below, that's a good level on the 60-minute chart. It's going to take us down to the next target. Really, the targets I laid out are on the daily chart, 1, 2, 3, 4, 5. And see, you can see it here too. That's that same level on the 60. So we broke down. And so here's one that's been moving lower and still looks good, but it's a volatile little sucker. Be careful with that one. All right, the other things I wanted to cover. Okay, well, we know Treasury yields, they've abated a little bit. Remember, IEF is the 10-year bond ETF. So when this goes up, it means rates are falling, and that was a case I made. We'll probably get a little abatement in yields here. And so far, this is a check mark for the bullish case for a rally, or at least it slows the odds a little bit of a market crashing here soon. If we can get a little rally here, pull back in rates, and so far we've gotten a little bit of that. That's happened. What else did I want to cover? So keep an eye on that one. I told you I was watching the California muni bond market. Big red flag to me that it's still, I've done a couple more Google searches, not today or yesterday, but since the first time I did last week. Nothing out there. In fact, the only thing I found in the last week or so, I think it was Fitch, gave some of California's GO bonds, those are general obligation bonds, backed by the full faith and credit, the taxing authority of the state. They gave them a AA rating and reaffirmed a stable outlook. Okay, the bond market's not agreeing with Fitch. I'm just telling you there's something here, because when you look at the national municipal bond market, it's still holding above the October, when the stock market bottomed, the mid-October highs right there. And then yet California bonds have been coming under a lot of selling pressure. And this is, the smartest of smart money. They deal in this sphere of bonds. Bonds are, the bond market in general, not just munis, but all bonds are much bigger than the stock market. And it tells there's maybe some cracks coming. And like I said, it wouldn't surprise me if it's including but not limited to severe shortfalls and underperformance in CalPERS, like I said, debt liabilities, the world's largest public pension fund. Or I should say the country's, I don't know, it might be the world's largest in the country. Oh, okay. Let me. This video is going long. Let me just wrap up crude. Crude oil, like I said, this is a net plus. Um, Crude oil is, I told you I'm reverse. I covered my short yesterday. There was a little above T2. I'm still long right now because remember, these were targets laid out here. We broke down. That was our initial short entry. This point here, I highlighted this downtrend line. I said, look, if they pop that, we're probably going to get a marginal but still divergent high and then go on down. And that's what happened. So we're coming up on my potential, and that's my final target. That's a good support level for crude. So in my opinion, crude has limited downside, and then it'll go back up. So if we, so far this abatement, the market will usually take a little while to react because at first pullback, it's just reading that as, a little pullback in an uptrend. And so this, after the masses see it and it becomes blatantly obvious that there's been a significant abatement in crude prices, that's when the market tends to rally, or at least that aspect of it. Remember, there's a lot of things, a lot of red flags in the market now. This isn't the only one, but that's an 11% drop. So at least it gives, the bulls that hope that, okay, wow, we're not going to exceed $100 crude oil right now. But I think just by the time the market starts to price it in as bullish, that's probably when we'll pick back up. And here, let me show you the crude futures. Okay, CL, crude futures. It's not big, but sometimes that's all it takes is a little divergent low. Here's a little divergent low right there. Went on to make a slightly lower but still divergent low, and you got this pop out of it, right? So you have positive divergence on the 60. I mean, first, even when you had the small divergent low right here and here, you still got a pretty decent tradable pop right there. So we have the divergence. And just like I showed you on USO, wouldn't surprise me to come down here. I see a little more downside. It's not much. We're talking 1.25%. On crude, that's not a lot, as much as it moves. So from here down to, but not below 81.25, I'm a buyer of crude. Anything more than that, and don't get married to it. Seeing these things, don't think, oh, it dropped already from the highs. It's already fallen 13. Crude futures have dropped 13.5%. Don't underestimate how low they can go, how high they can go. If anything, COVID taught us that when crude oil futures went negative, they were priced negative for the first time in history. Anyways, that had to do with storage issues. They had nowhere to store there was so much crude sloshing around they couldn't even store it, so you had to pay to get rid of it. Okay, so anyway, a little bit, a reprieve so far in the stock market's probably going to price this in on a lagged effect. The drop in crude maybe give us a little bounce here. Like I said, I made the case on the 5-minute charts to go long for a quick bounce. So that's that. So I like that on the long side, but on the other side, look at natural gas finally going. And so, you got these poor bulls. Like I said, there's so many red flags out there. So remember, natural gas, I've done some updates, including yesterday. It's been in this trading range, and I've highlighted you can keep buying pullbacks to the bottom of the range, give it a little room because they like to undercut, especially if you have divergence. And so far, boom, we've ripped up now to the top of the range. Again, that's the MO. Buy the bottom, sell the top, 12% rally. Now, we haven't broken out. And look, if you bought it at the bottom of the range, which was highlighted here and here recently, good time to book profits. Or if you want to allow, sometimes I'll do this. If I think there's a potential for what I call a runner trade, instead of booking profits, I'm going to give a little back, selling at 738. But I would put a stop, a little bit below. How low? I don't know. If you want to go tactically, you have I'm going to pull that line down there. There's support right there, about 715, a little bit below that. And so you're risking giving back some profits. But for the potential, if it breaks out and runs and just surprises everybody, because I think a lot of nat gas traders have fallen asleep at the wheel. You're thinking it just can't, but sooner or later, I think it's going to break out, and I think the breakout will be to the upside. And so I always say crude, yes, crude has the biggest impact on the economy as far as inflation, but don't underestimate natural gas. This is from the Department of Energy here, the EIA, and it says right there, straight from the horse's mouth. I always try to check my sources on the internet because some of them just get some blogger with 10 followers, and don't go off. Always check your stats, your sources. So this is the federal government here, and the source of I did U.S. electricity generation. So fossil fuels account for 60% of that. Of the fossil fuels, natural gas is used for 40%. So your electric bill, your heating, cooling, electricity, power generation, 40% of that, their cost comes from natural gas. 20% is coal and only 0.6 petroleum. So therefore, this little abatement in crude oil prices, market's going to cheer, but don't be careful. Natural gas, when she wants to scream, she can scream like no other commodity I've ever seen. I mean, that thing can make oversold look like it just blow right past there. So now, and that hasn't happened yet. We're right, in fact, we're right at the top of trading range. I can make a case to short it here because it's at the top of the trading range. But I could also, if it breaks out, like I said on the stock market this morning, react. You know, if it breaks out, it has a powerful basing pattern to put in, and that would just be another big thorn in the side or a yellow flag for the economy. It would just mean the inflation trade. It's like rolling inflation here or there. As soon as crude oil abates, and boom, now wheat's starting to run today and corn. So those guys are still set up productively. I still, they haven't been able to catch a bid lately, but the charts still look like they're set up for another big move up. All right, guys, I have to stop it here. This video has gone too long. We're at the 45-minute mark. As always, remember, when you're watching these, when I watch YouTube videos, I almost always put it on 1.5, sometimes 1.75 playback speed. You can always stop that, rewind, but that's down in the settings, so it can take really reduces the time. And all right, just wanted to give you that tip. All right, let me get it out to you. This has been Randy Finney with Right Side of the Chart. Just one quick update. I am going, wife and I are leaving to the Keys tomorrow about midday for the weekend. So I'll be gone, blackout on the road tomorrow all afternoon, and not getting home till probably Sunday evening. So that'll be the first updates you get between tomorrow morning and Sunday night at best. All right, this has been Randy Finney with Right Side of the Chart. Have a good one.